Okay, hi everybody. Welcome to the first 2022 Family Firm Investments Conference Call Fireside Chat. As I'll be talking about this, I'm going to promise that I did not write all this today based on what happened today. This is actually what I was thinking about talking about for a while now, and I think we'll find it very timely. You know, one of the many things I've come to know and appreciate about you, our clients, and actually ourselves is what I call our deep commitment to financial success for ourselves and our families. And one of the traits I believe many of us have in common, and perhaps I exemplify this to the nth degree, is that we are worriers. We buy insurance. We buy lots of insurance. We worry about health. We worry about politics. We worry about the market. We worry about our finances. Again, raising my hand as the chief worrier. And the primary topic of tonight's call is to discuss another worrisome issue, inflation. Where we are, what might the direction be, and should we worry about it? But I also just wanted to take a second and just pause and appreciate how we got to talking about inflation as a thing. You know, over the past 2 years, the combination of aggressive actions by the Federal Reserve, some massive government support, speedy rollout of generally effective vaccines, and most importantly, just the underlying resilience of the American economy have led to a very strong recovery from the brief but very deep trough in the pandemic. And the economic strength is best reflected in a low unemployment rate of just 4%, with wages rising respectively. So although I'll be talking about my inflation worries for the next few minutes, I'm actually pretty appreciative that this is our primary economic worry today and not something even scarier. So next, why does inflation warrant its central role in today's set of worries? Simply because an overheating inflationary economy can, should, will result in rising interest rates, which in addition to just simply hurting bond prices, also impacts stock prices by tightening financing and depressing valuation. So where are we today with inflation? Although it's sprouted worldwide, it's really America who's the biggest cause and also the most severe case. Inflation as of today is running at 7.5%, and with a stickiness that the Fed can no longer ignore or consider transitory. I think that word has been retired. Oh, by the way, I just wanted to mention 2021 did end up unfolding as we identified as the most likely scenario, what I had termed unsupervised in one of our prior calls. A strong economy with no tightening from the Fed or any kind of fiscal restraint. And the market effects even played out as we thought maybe they would, which was a bleak year for bonds and a robust stock market. This next question, maybe it's going to appear obvious to everyone, but why does inflation matter to us as financial planners? Well, we incorporate inflation into the financial planning process in the infamous Monte Carlo review. We assume a rate of 3% annually. We've done that in the 20 plus years I've been at the firm. We've always felt that was a conservative assumption to model with, and in fact, the inflation rate has been well below that for basically this entire time. So it did work. It was a conservative assumption. We felt great about it. But now one might ask, does the recent inflationary spike, as I just mentioned, 7.5%, does that warrant a change in that assumption? Because that could possibly shake things up as we look at our financial futures. And my answer sitting here today is no, it doesn't require a change in the assumptions, but there are probably more reasons for concern in today's world than maybe there have been over these preceding years. And I kind of have 6 reasons why, I think we should be a little bit more concerned. And just please, if you bear with me as I just run through them. One is that there is lessened competition throughout the economy now. Corporations, as we see if we go to buy something, really haven't had any difficulty in increasing prices in response to what do they call it, a supply chain crisis, or just rising input prices or wages. Consumers have been paying. There's no real balking at the increased prices for many goods, and in many economic sectors, competition is lacking, thanks in large part to the merger waves that were allowed to occur unchecked and consolidate a monopoly or near monopoly in so many industries and fields. So that's one, that's troublesome. A second thing to be concerned about, I guess, consumers are very flush right now, a ton of liquidity. The stock market is high, unemployment is low. The government's largesse from recent years is still to a large extent unspent, and not even by governments, corporations, as well as individuals. If and when some of this wealth is really spent on, choose anything, say travel, it's really quite easy to envisage shortages and price jumps, as all of a sudden there's a huge spike in demand that people aren't prepared for. So that's a second. A third reason, at least for concern, is really how inflation has played out so far. It's been mostly in durable goods, things like autos, new and used, housing materials, things like that. The service share of the economy, which is really the great majority of economic activity, hasn't really even seen inflation yet, sizable. But there are pretty valid reasons to expect this to happen soon. People who work in services, and that's really most of us, we've been eating, we've been buying cars, we have to drive, we have to work at home, we have to buy furniture. We've all seen prices rise on so many different things. So it seems fairly probable that service providers will have to raise their prices as well. And that, I can't imagine that it won't happen, and that will appear in upcoming data. Number 4, another big area of inflation has been in housing prices. And a proxy for housing and rental rates is actually the single largest component of the consumer price index. And actually, that really hasn't even gotten into the data yet, the CPI data. I'm not quite sure I completely understand why, but there's a lag between what happens in the housing market and how that eventually filters into the CPI. So that's on the way. And that's also a very sticky indicator that's hard to bring down. So we're going to end up seeing that in the next few years. And just have a couple of other 2 reasons for concern that maybe just are a little bit more ephemeral, but I think just kind of happening in society overall. One of which is what I'm just going to call the retreat from globalization. It was sort of happening before in the Trump administration with some other geopolitical things that have been going on, but particularly with the pandemic, where a lot of nations realize that, we can't rely on foreign suppliers for everything, especially in a crisis. And so many nations are what they call reshoring their production, bringing industries back home, which, it's got its pluses and minuses, but usually from an economic point of view is suboptimal and is more costly than to find the most economic location. And number 6 is what's happening in response to climate change. So for those who follow it, investments in the conventional energy space have really fallen dramatically, as with divestment, and many investors no longer want to be touching fossil fuels. That really has increased the odds of shortages and further price gains as demand really has continued to climb, and especially as the pandemic fades into the past. And the switch to alternative energy, not only will it take a while, it's also going to require huge amounts of spending, almost unimaginable and will also end up leading to lots of shortages of various crucial materials. So quite a laundry list. And I guess the question I ask is all that enough to break us from the 3% inflation assumption? And I'm still saying no, not yet, because there's still deflationary trends in society for sure. But I definitely think, you know, we're going to keep a really good eye on it, do as much analysis as we can, and of course, worry about it. So when when we sent out the notification about the call, I got a great question from a very astute client who asked if, you know, now that the Fed has admitted it was wrong and that inflation isn't transitory, are we entering what I had identified as the stern parenting environment, wherein aggressive actions are taken to subdue inflation at the cost of an economic slowdown or maybe even a recession? And that's a great question, but my belief, it hasn't really been completely shaken from today. But my belief is that calling what's likely to occur stern parenting, it's not quite right. And if maybe to me, like a more important analogy or more appropriate analogy is when a parent says, okay, you've really been acting up. I really need to step in here. No Xbox for 2 weeks. That's it. Stern parenting. And then after a day or two, oh, it's rainy, we're tired, and the Xbox is back. Maybe I wouldn't call that indulgent parenting, but I wouldn't call it stern parenting either. That's kind of what I'm thinking is sort of the mood of what might be happening. So what might end up happening from the Fed is just kind of a series of smallish interest rate increases over the next year or so, all of which carefully communicated to the markets in the hope that this, along with the lingering hopes that everything really is transitory, if that'll get inflation back under control to the 2 to 3% level they appear to be shooting for. You know, in other words, with everything designed to reassure investors, consistent really with how they've been behaving for many, many years, where reassuring investors, keeping investor confidence high has been perhaps their paramount concern. So if they're right and all this works, inflation comes down to this 2 to 3% level, wow, we will be looking at a really strong investment environment for stocks. We'll still be in this low tax, light regulation, easy financing, you know, at a higher interest rate, but nothing that everyone can't deal with. However, if they're wrong and the belief takes hold that inflation is out of control and the Fed has fallen too far behind the curve, as opposed to now where they may be only 6 months behind the curve, then, well, I just have to say, look out, because long-term interest rates would shoot rapidly higher. And then the Fed would really have to assume the role of the stern parent and act pretty firmly to squelch things. And that just wouldn't be very pleasant. So all this leaves me as the chief worrier to hope for the best, but prepare for the worst. You know, I say continue because I do think this is already in place, but it's become more and more prominent, I think, in the portfolios, to underweight those financial assets that are most vulnerable to large unexpected interest rate jumps. So the really obvious one are long-term bonds, and also pretty obvious are companies whose valuations seem most dependent on low interest rates. And the market volatility of these past few months has really demonstrated that those vulnerable companies are the faster growing in the technology stocks, as well as the numerous companies that have come to market over the past year or two with a story, sometimes barely a story, and kind of a vague business model. Those are, they're at risk if financial conditions really tighten up. So in saying all this, I fully recognize that if the optimistic scenario unfolds, and I hope it does, it's quite likely that we're going to miss some of the upside. And I would gladly make that concession, knowing that we've taken the steps to prepare for the worst. And I also just want to acknowledge that no matter how carefully we analyze and predict and say this and say that, there's going to be wild cards that will emerge, you know, next week, next month, over the next year. That'll present challenges, but it could also present opportunities along the way. So with that, I would love to hear, your thoughts, what you have in mind, any questions that you have, and I'll do my best.
Hey, Nate, this is Dave Ferguson.
Hi, Dave.
With the I'm not like a cryptocurrency guy. I've never dabbled in it, but I have to ask because it's so prominent today. In everywhere you look, and I am definitely not looking at it. But just want to kind of get the firm's view on crypto, and maybe crystal ball look at what that investment vehicle even means for the future.
Yeah. Well, I've been a consistent bear, or I don't think it's because I don't understand it, but I don't really understand everything about it. I don't understand, Dogecoin or something that started as a joke and become worth $70 billion. So I have to admit that one kind of escapes me. I do think that some of the technology behind it in terms of blockchains and using computing power to, as they call it, decentralized finance, so it's not all controlled by the bank. That certainly can be a force for good in society, and maybe as it plays into different fields, the legal field and some other areas, I can see it being pretty valuable. But as a notion that this will be replacing paper money and government money, I don't see it. And it's really just, it's still just person A trading into person B, who's trading into person C. And it's all just, not all, but the great majority of it is just built on faith and hope, and that honestly, that person C will be able to borrow the money to buy it from person B. And again, if interest rates go up and some of these really terrible financial innovations that have sprung up around crypto, like being able to buy with options and futures and massively leveraged, if the conditions tighten up and we can't all get our margin rate loans and play in options for free, wow, they're going to be hurt badly because there's no financial underpinning under them, and that's a scary environment. So it could be, again, to me, the optimistic point of view is that, wow, there's some of the, all the great technology that's going into developing some of these things, that it can end up being very worthwhile for the economy overall. But for those speculating in it, especially some of the more recent ones, I think they'll just be able to find somebody else to buy it from them. I do my best to discourage people from doing that.
No, thanks for the answer. I agree with you. I mean, the underpinnings are just unclear. So thank you for the insight and philosophy.
Thanks, Dave. And it's as much as I would like to just kind of wish it would go away, but it's just, gosh, it's so prominent now. And even some of the, like the financial screens, if you sign on to, to look at what's happening in the markets, and it's one of the most prominent prices displayed. CNBC or Bloomberg, there it is. It shows up as much as the S&P 500 does, which is a little scary.
Thank you very much for the presentation. It's a question about inflation, and it's there seems to be sort of a sense that, or at least there's a hope on the part of the administration that the rate will go down back down to where the assumption level is towards
Mhm.
the end of the year. But the question is, from your vantage point, is the administration pursuing policies that are likely to achieve that result, or are there things that you think, at least from a federal government level, in terms of economic and fiscal policy, that the administration should be pursuing that they're not?
Well, if we look back at over the Biden administration, it's going to turn out that the first the COVID rescue package from last year was too big. It was too big. Too much money was sent out. There's nothing that can be done about that now, honestly. And there were lots of people that needed it, that needed help. It's just going to turn out that it was too big, and it created too much money in the economy. That's it can't really be soaked up by anything. I mean, the only thing you could possibly conjecture would be a tax increase. And what everyone might think of him, Manchin from West Virginia did propose that as that's really what maybe should be the focus of things. But that's a non-starter. So that would be one thing that could maybe soak up some of the money that's floating around. They've kind of talked a little bit about some antitrust things to try to inject some competition into some areas. That's it's great. I mean, I completely support that, but that's something that would play out over years and years and years and years and years. We're not just going to have some policy and all of a sudden Boeing has a competitor. This is just the situation that we're in. It's going to take many years and a really concerted effort throughout all branches to kind of restore competition to some things. And that's, unfortunately, I think it's just kind of the way it is. It's really, I think this particular situation we're in was just a combination of the steps necessary and then perhaps superfluous to combat the pandemic, along with the Federal Reserve, which is independent of the administration, that was asleep at the switch. I'm just going to say it. They were just too complacent about inflation, and now they're going to have to scramble to try to restore that. I guess from the position of Treasury, they could support that policy, the Fed policy, but there probably won't be too much that they can do about things in the near term that would change the trajectory. Things like saying, "Oh, we're going to release oil from the strategic reserve" and things like that. I mean, it didn't really make sense in the 1970s, and it doesn't make sense now.
Thanks very much, Nate.
Sure, thanks. I wish it was easier.
Yeah, I just say it really comes back to maybe the stern parenting question that it's another way of asking that same question, I think, in terms of whether we're going to have permissive parenting or stern parenting. But thank you very much.
Sure, thanks.
Anyone else like to ask Nate a question? So thank you all for joining.